has been quite a status quo policy, except for the bank nifty, which is off the day's high, and maybe there is some trepidation in the fact that the marginal cost of funds will eventually possibly impact margins. But overall, Anuj, up around 0.3% for the nifty. The mid-cap index is outperforming. This is exactly what I told you at 11 a.m.
You know, two points, Ekta. One is that this was supposed to be a non-event policy, and that's how it turned out to be. You know, the market actually only went up even after it found out that it was a bit more hawkish. 2 points stand out for me from what Governor Rajan had to say. One was that he's saying that he's vigilant on inflation, but he's also accommodative. The fact that he did not cut rates, and at the same time, you know, he said if and when we are more accommodative. So he said, you know, that's being read wrongly, just because this time we haven't cut rates, but we still remain accommodative. And the second point was that his focus on transmission. And I think that's something that we'll ask the banks, because quite clearly he's saying that we have barely seen half the rate cuts being passed since the start of January. And that, I think, is the bigger critical question, and that is something which the money market is also reflecting, you know, which is fairly not pricing in any rate cut, while we have seen, what, 125 basis point rate cut. So that, I think, are the two key points that stand out, but we should go to our guest for that.
Yes, in fact, we have Sonal Varma joining in from Nomura, as well as the bankers are still with us. Mr. Tiwari as well as Mr. Gupta of SBI are with us. Sonal, I'll come to you first. This was largely in line with what you were expecting from the RBI. What did you make of the tone? Slightly hawkish, according to you?
Largely in line with expectations. I won't say hawkish. I mean, you know, the governor, even though it wasn't explicitly in the statement, but in the press conference, he said that the policy stance still remains accommodative. So, you know, per se, as per the Reserve Bank, they will use the space when available to provide more accommodation. Our view, of course, is that they won't be able to find that space, because the risk to the medium-term inflation forecast that the Reserve Bank has, which is 5% for now, you know, we think that risks are to the upside. And actually, we were looking forward to listening to what Reserve Bank thought about the March 17 target, which they had indicated in the previous policy. Their expectation was around 4.8%, but there wasn't actually anything explicit on that. So that was a bit of a surprise, but other than largely on expected lines.
Okay, let's ask the bankers, because, you know, the second point was on transmission. Mr. Tiwari, you know, the RBI governor saying that banks have transmitted less than half of what we have cut, and that still needs to happen. Your response to that?
In fact, we are a forgetful person. When these repo rates were going up, base rate did not go up in the same proportion. Why we are forgetting that? Number one. Number two, when we are talking about the economy, it's not just the base rate which is going to impact it. There are other contributory factors also. I would rather ask, instead of answering, this 70-60 basis point cut, in what manner it has benefited the economy?
Sure.
In a larger perspective, there are greater issues which are also to be addressed simultaneously. Marginal cost of fund, as of today, the structure of my resources is, so about 80% comes out of term deposit. Of that, just about 1/4 or maybe 28-30% comes for repricing every quarter. So whatever accommodative headroom I have or a banker has, they are doing it.
Okay, Mr. Tiwari, I just wanted to follow that up. Once there is a movement to the marginal cost of funds, how do you think that will impact your asset liability matches, as well as in terms of your net interest margins? There are some analysts who are estimating at least a 10 to 15 basis points impact on the margins on the downside. Would that be a fair assessment?
Yes, it should be not 15 basis point, I believe, because this was done in consultation with the new framework for the marginal cost of funding at the aegis of Indian Banks Association, and that those suggestions have gone about 2 to 3 weeks back to Reserve Bank of India, and what Governor said this morning, maybe within a week's time it will be in place. Look, this is a new framework. We have done our back testing on the new framework, and it's not going to impact to the extent of 15 basis point. For sure.
Okay. Jehangir Aziz of JP Morgan also joins in. Jehangir, your sense in terms of the policy this time, and What is your assessment in terms of how CPI could pan out in the next couple of months?
Look, I mean, this was, more or less on expected lines, so it wasn't big of a surprise. I think the point that the governor made, or in the statement made, that the CPI is most likely to move up in the next few months is also likely to happen. That's also where we have our views. After that, the argument that it's going to plateau, that's where I think we differ from where the RBI sees the inflation rate. Pretty much depends upon what your views are on oil prices and the extent to which, if and when oil prices start to move back up, does the government actually roll back this massive amount of increase in excise taxes to prevent that from going into retail prices, or does it actually pass it on to retail prices? That's the big uncertainty, and that uncertainty is going to drive, at least the fuel-related part of inflation. But I think a bigger part, of course, depends upon where growth is in 2016 and, what kind of excess capacity we have in the economy in 2016. And again, I think there we differ from probably the RBI, even though the RBI hasn't said very much about 2016, 2017 growth rate, but we clearly differ from where the market sees India's growth in 2016 and 17.
Yep. Hi, Jehangir, Sonal, Mr. Gupta, Amar, and Ekta. Well, I guess there's nothing much to summarize from the governor's press conference itself. I think what the governor reiterated was, if anybody had doubts that he has become extra cautious, he perhaps wanted to reiterate that they are still in accommodation mode. And the other big takeaway, I guess, also is that there will be a one-time increase in wages and rents, possibly because of the seventh pay commission, but they intend to look through that increase in house rent, and they will look at the momentum excluding that impact. So we needn't really worry whether they will get extra hawkish or extra careful because of the impact of the seventh pay commission. At the moment, they expect that the fiscal deficit will counter, that the control of government expenditure will counter whatever impact the seventh pay commission will bring in. That at least is what they are working with. But on that point, let me get the economist before I get the banker, because there seems to be less for the banker in this policy. Sonal, from everything that the governor said in the policy and in the conference, what are you getting a sense of in terms of when is the next cut and how many cuts in 2016?
Well, the governor's stance seems to be in sort of a wait-and-watch mode in terms of seeing, how the underlying CPI evolves, given that, that itself is linked to what happens to different factors, including food, fuel, expectations, the pay commission recommendations, although they are going to look through the one-off impact. So how the underlying inflation trajectory pans out relative to their targets. And second, how the transmission pans out, particularly after the marginal cost of funding and the small savings deregulation takes place. So those are the two key factors that they are going to be watching out for. Clearly, they've left the room open for more accommodation if the room becomes available. But as I was discussing earlier, our view is that the output gap has started to close in India. It's still fairly negative, but over the course of the next 12 to 18 months, we are expecting the output gap to close. In fact, one of the surprising factors in the last 12 months has been that despite, all disinflationary forces being at work, whether, global food, global oil, rural wages being low, growth being as weak as it is, if you look at the underlying CPI inflation, where it was at the start of 2015, and where is it today, and where it is today, it hasn't really changed much despite all these disinflationary factors playing out. So the big question we are asking ourselves is, what really drives the underlying disinflation in 2016? And underlying inflation, in our view, is still between 5 to 5.5%. So our view is, the 5% target for early 17. There are clear upside risks to that. And while we can ignore the inflationary effect of the housing rent component, ultimately, it's the 1 trillion INR of additional money that is going to be given to central government employees, to railways, part of the payment for Jan to March period, which will also be paid retrospectively. And plus, not to forget that states are going to implement the pay commission also in the next 12 to 18 months. The cumulative money that is going towards enhancing consumption is quite significant. And we have a situation where expectations have remained elevated because of shocks from one food item to another. So I think the Reserve Bank is likely to remain cautious, even if the headline is driven by one-off factors. So while they've left the room open for easing, if the room opens up, we are not expecting any cuts now going forward. So we have the Reserve Bank on hold for 2016.
Okay, that's saying a lot. Sonal, I'll come back to Jehangir on the similar question. But Mr. Gupta, there isn't anything specific for banks except that you will be moved to marginal costs. What will be the impact on SBI itself? The rules are going to come later this week. I guess it will kick in from March 31st or April 1st. But how much will you therefore be forced to bring your rates down?
No, but I think let us wait and see what exactly the guidelines say. So I think it would be totally premature to say anything on this at this point of time. If need be that, the banks will restructure their own portfolio, they will look at their asset liability mismatches, what are the kind of rates they offer on various kinds of deposits, and how do they price the loans. So I think all the readjustments will happen, and I don't really think that the impact will be that much. But I think we really need to look at what happens to the existing loans also. See.
Exactly. I completely take your point that the RBI has not quite answered those people who have a flexible rate and who will expect it to be passed on whenever there is a base rate cut. But separately, the HDFC Bank clearly said that because they've moved to marginal cost, they were able to cut by 35 basis points. You will have some arithmetic done. When you get to marginal cost, how much will your rates fall or your NIM shrink?
No, actually, if you look at how the banks already fix their base rates, the marginal rate does play a very important role. We look at existing rates and then only we decide a base rate. So in a way, we are actually on the marginal
cost plays a marginal role. It is your average cost.
No, it is not actually. I think, the RBI as of now has base rate formulas. You can use the marginal cost, you can use the average cost of a particular bucket, or you can use average cost for your entire portfolio. So when you are using actually, average cost based on... I think we need to wait and see what the guidelines are actually. Yeah.
Okay.
In a way I said that we are already on the marginal cost because... what we use is we use the existing rates that the banks offer on various time buckets actually. What the Reserve Bank of India requires is that we must, use the buckets where we get the maximum deposits that come in. So as we are using that as a base for fixing the base rate, so in a way we are already on the marginal cost. So ultimately what we really need to see is what exactly the guidelines say and how they will impact. And I guess there will be enough time given to the banks to be able to readjust and see that how they actually proceed going forward. So I don't really see there will be too much of an impact actually.
Oh, really? Okay, that will be a bit disappointing for the governor and for industry, I would assume. But separately, you don't see any scope immediately for any rate cut at all, probably because of lower demand or because your old deposit rate cuts are now giving you a little more space. No space at all. You don't see any scope for a base rate cut in the next 1 quarter or in the next 1 month?
No, I think as I said earlier, we have already cut by the 70 basis points, which is the maximum by anybody in the industry. Okay, and we have already cut a deposit rate. As the, the benefits start flowing into the banks, the further rate cuts can happen. But in a way, in fact, when we cut a base rate, we also to an extent front-loaded it because the savings had not really come in. So if you see our first quarter results, there was actually quite a sharp dip in NIM because we had cut the base rate without actually getting in full the benefit of deposit rate cuts. So I think those benefits have started coming in. So we really need to look at how our cost works going forward, and then we will take a further call on what further cuts can be affected actually. I think he also mentioned something about the market benchmark. I think that is something we need to go to. But, there again, there are a lot of questions on, like it's like a chicken and egg, the market benchmark, how does it develop actually? So whether, you start pricing some loans based on a benchmark, and the benchmark would only be a polled price, or it's based on some actual deals that got done at the benchmarks. I think ultimately that would be a solution, but we really need to see how it all pans out.
So you don't see any deposit rate cut either immediately? Okay. Oh, I think I'm not able to get through to Mr. Gupta. A word from Amar Ambani as well. Amar, any changed position on banks at all? There was one new date which the governor put on the table saying that he wants the bank's balance sheet cleaned up by March 2017. Do you see some accelerated efforts to clean up NPL? Anything in this policy that makes banks more attractive or less attractive?
Nothing policy specific as such. I think it was largely along expected lines. So I don't think, except a sentimental impact, much is going to be made as far as bank stocks are concerned by the market. But like you said, I think the effort to clean up asset quality, the acceleration there will only help, because the problem is that today our banking system has asset quality issues. When you talk to a lot of people, for their views, they say there is still a lot of pain and it needs to be addressed. The problem is that it is all under the table. So till you bring all of that, from below the carpet and deal with it, you really won't be able to solve this problem and, improve the economy as far as from a long haul perspective. So I think it will be a good, move by the RBI if they help and in many ways enable the banking system to clean up these assets. Because all these issues, the ones which have gone bad, they can restructure if the project viability is still there. Others which are genuine cases, you have to go after the money. So I think that statement is a positive, but other than that, not much for the banking stocks as such.
All right. Just come back to you in a minute on whether there's anything at all in terms of an interest rate expectation, Amar. But we have someone who can read these things much better than most of us. Ananth Narayan of Standard Chartered Bank has also joined us. Ananth, through the press conference and the RBI statement, what is the sense you're getting 1 year down the line? Where may the tenure be? Or even for that matter, 4 months down the line, say after the budget?
Lata, I don't even know where it will be 1 month down the line. But look, going through the policy, I guess it was along expected lines. More cautious than the September 29th policy for obvious reasons. The fact that, you have calmer markets, there are inflation risks and budgetary risks and so on and so forth. I think what the market specifically was looking for was, A, there's a problem as far as supply and demand mismatch is concerned. As the governor mentioned in the conference, there's been a surfeit of supply, including state government bonds, and not enough of demand to pick it up. And that's sort of caused some amount of pressure on bond prices currently. We were hoping for some indication that there might be RBI coming into the market and maybe buying bonds, both to ease the liquidity situation as well as to support bond prices in some way. At least the press conference didn't give that as an indication, so that's a bit of a disappointment. The other point, of course, bankers clearly have not been successful in explaining to the RBI that the current liquidity paradigm, where we are again going close to 1 trillion of shortfall in daily liquidity, the start of day, is a problem for transmission. Clearly, the RBI doesn't recognize that as a problem. And I think that remains a point of discussion between banks and RBI to be continued. As far as I can see, this liquidity shortage, which will probably aggravate over the next few days, will only be a further impediment to transmission that Mr. Gupta was earlier mentioning, which unfortunately remains unresolved.
Yep, absolutely. The advance tax payments will come, and I guess there will be even less cash, excess cash, or more deficit in the system. So you think you get close to 7.9 now, or probably stay at 7.8 on the 10-year?
No, to be fair to the RBI, the overnight rates remain pretty much anchored close to the 6.75 mark. It's about 6.95 or so right now. So that should give some relief. The carry of about 1% or close to 1% is reasonable. Having said that, don't see any fresh respite and coming down of yields in the near term. One has to wait to see if what the impact of increase in FPI quotas and maybe once the supply subsides going into the next year, at that point of time, how things look like. But there is a problem in terms of supply and demand right now. There is a problem in terms of liquidity. And of course, LCR fresh rules kick in from 1st of January, which will only put further pressure on the whole transmission debate as well.
Okay. No, there's a fair point in all that. Ananth, just wanted all you experts to guess on, how many rate cuts you can expect. Sonal just told us that she doesn't expect any cut at all in 2016. What are you working with after the statement and the projections and everything that was said in the conference?
Look, I think Sonal and the economists make a fair point. The reality is we have very little guidance on where CPI could end up in March 2017. There are far too many imponderables, with a predominant amount of food into the CPI index and, fears about what the weather could be the next year going forward. It's very, very difficult to put a finger on where inflation will really center around. But if I look at the ancillary points beside inflation, whether it's tepid credit offtake, whether it's the low capacity utilization, whether it's the stressed balance sheets of corporates and banks, whether it's the lack of participation of private parties in the investment cycle, and of course an overvalued rupee and a high interest rate differential with most currencies contributing to that. I think there are very, very large arguments to be made for bringing down rates, ignoring CPI for the time being. And I'm personally hopeful that we'll have room for 50 basis points of rate cut. As you asked in the conference, in the press conference, at least if you look at the real rate compared to inflation expectations versus the one-year T-bill rate, there is room for 50 basis points of rate cut more. Once the budget is behind us in February, and hopefully the government shows its resilience on the fiscal path, maybe the RBI will have room, given the state of the economy overall, to pursue a few more rate cuts and to the extent of maybe 50 basis points.
Okay, actually, I want to quickly wind up this conversation since it really is a no-impact policy. Just a quick word on something outside this policy. Ananth, inclusion of yuan into the SDR basket at the prospective date. Should we see eventual devaluation of the yuan? As a currency trader, how are you responding?
I wouldn't see the inclusion into the SDR basket by itself as being a trigger for one way or the other. This is a reflection of the fact that the yuan is becoming more and more relevant in the global markets, both from an export perspective as well as from a financial kind of internationalization of the yuan. There are concerns overall, though, about where the yuan is headed from here. There are concerns about the Chinese economy, about the strength of the Chinese economy, about the health of the financial system there. And to that extent, there are concerns that maybe the hotspot to worry about is really China rather than Europe or the Americas. Now, if we do see a reaction in Chinese growth and therefore a weakness in the currency, obviously that will have an impact on the globe as a whole, including the rupee. So that's definitely something to watch out for. At the moment, our own house view is that growth will be a lot more sanguine in China than the market expects. But it clearly remains an area of concern for all of us to watch. And if China happens to sneeze, we'll all definitely catch a cold.
Yes, fair enough. Thank you very much, Ananth, for joining us. Just one last word with Jehangir. Same question to you, actually. What are you all penciling in after listening to the governor and your own projections of CPI? Any cuts at all in 2016? The governor was very clear. If anybody thought he's cautious, he said we are in accommodative mode. He said that a couple of times.
Maybe one rate cut after the budget, and that depends pretty much on what the budget will look like. The budget this year for 2016-17 is going to be an extremely difficult arithmetic. If the government wants to deliver 0.5 percentage points of fiscal consolidation with additional 0.5 percentage points of wage increase, and the fact that it won't have 0.5 percentage point of excise taxes on oil to play around with. This would, if the government delivers on all of that, it will be the largest single fiscal consolidation the government India has ever done, probably in 25 years. So depending upon how that pans out, and maybe there is one rate cut, but beyond that, it's very difficult to see more easing than that. the inflation dynamics goes against the rate cuts. More importantly, we would probably by that time have had seen at least 2 rate hikes by the Fed. And my sense is that the only real reason is if you do get a rate cut is if growth slows down, given the fact that much of the growth in this year has been driven by this massive terms of trade shock, which basically fades off or is already starting to fade off. So maybe if growth weakens, we might get 1 rate cut post the budget, and that too contingent on how good the budget is.
All right. Sonal, Jehangir, Mr. Gupta, Amar, Ananth, all of you, thank you very much for joining us in this special coverage of the Reserve Bank credit policy. Actually, that's a lot of people and a lot of time we have spent on a policy that has not made any difference, really. It's a continuation policy, a status quo policy, remains as dovish or hawkish or as neutral as the previous one was. Our experts like Sonal and Jehangir are very parsimonious in terms of expectations of rate cuts in the next year, more because of extraneous reasons, not because of what the Reserve Bank said, because they think that any further fall in commodity prices is not to be expected, and that the 7th Pay Commission and fiscal consolidation will bring its own pressures. So not expecting too much by way of cut. The banker made it very clear. They are not moving on rates just yet, and even after the marginal cost gets worked into the base rate, they are not going to cut rates much. And look at the markets, they've not done anything at all. Before the policy, after the policy, the rupee is rock steady. The markets are pretty much where they are. So Ekta, Anuj, really back to you. It's business as usual, markets as usual.